So today we're going to talk about building the first part of our valuation model that we're going to use this semester, and we're going to use Anheuser-Busch InBev as an example. So to get started, if you go to the Files section of Elms, you will see a folder called Files, and there's a folder called ABI Model, and in there are two files. There's a file called ABI Data, and there's a file called the Valuation Model ABI Start. So you'll need that file to follow along in this section. So what you're going to need to do is, in just a minute, I'm going to start with that Excel file, and you're going to basically need to create everything that I do in Excel. And so at the end of this video, we would have built the first half of the valuation model, and you need to complete that model individually and catch up to exactly where I am. Now, I'm going to tell you a little bit more about what I did before we got to the model, which you will do later once we reuse this model to use it for another company. So to prepare the model, I actually went to Bloomberg to get this file called abidata.xlsx. So in Bloomberg, and you can see this here for Anheuser-Busch InBev. Basically, what we'll need to do is go to the FA section, and in the Custom tab, you will need to create at a later date and time a template, which I call model. And this has income statement, balance sheet, and cash flow items. Basically, there's 80 of them that are going to come from Bloomberg because, unfortunately, the income statement and balance sheet that Bloomberg actually shows us does not come in a completely standardized format. So since we are going to need to put this in Excel so that Excel knows that every time I look for a certain item, such as revenue, it's going to come on a certain row. Well, the problem is if we use the standardized templates within Bloomberg, they're not standardized. So sometimes they will put revenue on row 5, sometimes in row 6, sometimes in row 7, and that will cause problems for a reusable model. So what we're going to do is we're going to create this template, which says, here's all the data fields we need, and then we're going to build a model to use this template with that data for any company. And again, for this exercise, you won't do this. I've already done this, but for a later exercise, you will need to create this reusable template. So what I've done here is on the Bloomberg field for settings, we're going to use 6 years of historical data. So I need to make sure that my number of periods is 6. I want standardized. For the data, I want to make sure that I don't have any of these boxes checked because I don't want any miscellaneous data in my export. For display, I want things to go in an ascending order, which means the most current year will be on the right. And for Excel, I want to export as values as opposed to formulas so that the data that I get is actually numbers that as I leave the lab and I'm not near a Bloomberg terminal, then it won't have a problem always trying to look back up the data in real time with Bloomberg, which is what happens if you do formulas. So make sure that you would export values. So go ahead and cancel this. So what I do is I go to ABI InBev, I go to the FA section, go to my custom template, and then I output to this template to Excel. And then what Excel will do is it will then take the latest data, latest 6 years of data, and it will give it to me in a numbers format. Now the final step is Excel is going to choke on dashes because we're going to use references to this tab in our model. And so basically we can't have dashes. We're going to have to replace the dashes with zeros. So what that means is if I hit find, Control F, and what I'm going to do is replace. And then if I come here and I copy the dashes, put it into find the dashes, replace with zeros, then I'm going to replace all. And that's a very important step because Anheuser-Busch InBev has 36 fields, which are blank, and Bloomberg exports those as dashes, but Excel's not going to like the dashes. So we're just going to treat those as zeros. So this is an important step every time you export data in your model. So I've done that. I have saved this file, and this file that I've saved is called, won't save that one, and won't save that one. It is called ABI data.xlsx, and that's the file that I uploaded. So with this file, and this is just another copy of the file, I'm now going to go to our valuation model. So this is our valuation model that we're going to build with. It's called Valuation Model ABI Start for Anheuser-Busch InBev. And again, we're going to build a reusable model. And in order to facilitate doing that, it has a series of tabs which go to the left from left to right. The first tab is going to be called the Model Data tab. And it is this Model Data tab that comes from this data spreadsheet. So when we reuse the model, so I'll go ahead and start the process, what I would do is I would take my data, I would copy it, I would come here to the model, select the whole tab, row for row, paste special values to upload the most recent company's data for those 6 periods into the model. Now, I've already done that. You don't have to do this step, but that is a step that you will have to do when we reuse this model for other companies. And this is how we update the company data. Okay, so this is where we're going to start. So what the model then does is it takes this data and it puts it into standardized income statements and balance sheets from this raw data. And then the next step that I've done for you is I have a tab called TFI, and this rearranges the balance sheet into the total funds available to investors. This rearranges and maps to our standardized income statement to rearrange it into a matching TII, total income available to investors. And then this tab takes the TII and TFI and creates a matching CFI. So again, I've done in this model basically, and these are all referenceable cells, you can see the formulas here, that basically it maps the economic statements to these standardized income statements and balance sheets, which are being created from the data dump that is coming from Bloomberg. I also have economic profit, both beginning of year and end of year. And there's a tab here for historical ROIC. And more importantly, there's the ROIC chart, which has the detailed ROIC table, which we're doing analysis on. And again, all of this is reference data, which comes from the converted TII and TFI for the company. So that's just kind of a basic layout of the model. A couple more tabs that are important. One is called assumptions, and the other is called ratios. So one of the best practices that the book talks about is that you want to minimize the places where you're going to make assumptions and changes to your model so that when you reuse the model, you're not looking all through it. So as a best practice, you put it in fewer places, and it's easier to then change the model. So all of the changes that we're going to make are going to come in 2 tabs. Assumptions cover miscellaneous assumptions that are generic throughout the model. And so in this case, we're going to build, but we're going to start with 3. What is the last reported year? So it's a relative model. Operating cash as a percentage of revenue, and we're going to start out with the assumption of a WACC. Then the other place where we're going to make changes is on the ratios. And this is where we're going to start building the model. And so again, the process that we talked about in class and that we're going to use to do valuation as a best practice is what we're going to do. And I'll kill this just to get it out of the way and make this a little bit bigger. So hopefully it's easier to see. All right. So the best practice is we are going to take historical ratios, which we have here. These are historical income statement and balance sheet ratios. And we are going to forecast those ratios. And then using the forecasted ratios, we're going to create forecasted statements. So our goal is that we talk about in the book that the valuation, in this case, we're going to choose 5 arbitrary years of year-by-year forecast, and year 6 will be the beginning of the continuing value period. So in order to do that, we always need to forecast a T+1 period, the first year of the continuing value, which will be year 6. So what we're going to do is we're going to forecast out 6 years of ratios, which will create 6 years of forecasted statements and then 6 years of cash flows. Okay, 5 years will become our defined period where we will forecast Anheuser-Busch InBev and other companies year by year. And then the year 6 will be the beginning of the continuing value period. And we'll use those ratios in the key value drivers formula to begin our key value driver formula assumption for the valuation in the continuing value period. So our goal in part 1 is to create that generic 6-year forecast in our model. So what I'm going to do, and again, it's very important to use relative references, is we're going to start out forecasting the income statement first. So on the ratios tab, equals previous year plus 1. Because again, as the years change, we want the model to auto adjust. Right? Now, as a placeholder, we're eventually going to forecast the numbers, but as a placeholder, we're just going to say equals the previous year for revenue growth. So as a starting point, let's say ABI grows in 2017 at the same rate it grows in 2016. What I'm next going to do is I'm going to make this cell, and I'm just arbitrarily choosing the color yellow. You can choose whatever color you want. But what I also want to do is I want to tell myself which cells I can change and which cells I shouldn't change when I make changes to the model. Because there's a lot of formulas in here, a lot of references, and I want to break the model accidentally by overwriting a formula. So we're going to use the concept of color, and I've arbitrarily picked yellow to say this is a cell I can change, and it won't break the model, and it allows me to make an assumption here. Versus cells that aren't in color yellow, I don't want to change because those are cells that are calculations, and they would eventually break the model. So in this case, we're going to put a placeholder here for revenue growth, and we're going to equal the previous year. Okay, so here's how it's going to work, and I'll just give you an example of this. So we're going to then go to the income statement, and this is going to be the forecast. Again, equal previous year plus 1. And the way we're going to forecast revenue is we're going to say, okay, take previous year revenue, multiply by 1 plus, from the ratios tab, the 2017 revenue growth rate. And again, I'll make this consistent with currency to 1 decimal place. So here's the idea. I'm going to create a forecast for revenue 2017 based on this ratio. So if revenue grows by 4.4%, then in the income tab, that would turn it into 47,513.9. If I wanted to say 8%, then on the income tab, it would show an 8% revenue growth. If I wanted to say 2%, then this would be a 2% revenue growth rate. So that's what we're eventually going to do when we finish up the valuation of a company. But right now, as a placeholder, what I want us to do, equal previous year. So we're just going to build a model, assuming nothing changes, and then later we'll put in more realistic data for what we think is going to happen in the future, and that will create our forecast for cash flows. So what are we going to forecast? Well, we need to forecast revenue growth rate, and then we need to forecast cost of revenue and operating expenses and gross profit. But here's the deal, and you can see it's kind of highlighted over in blue. What matters most when we forecast is actually our forecast for EBITDA. So if this were the real world, companies care about the forecast of gross profit and SG&A operating expenses. But for practicality purposes, the valuation doesn't matter as much as it does to create the forecast for EBITDA. So rather than granularly forecasting each of those numbers, we're going to directly forecast EBITDA. So equals previous year. And again, I'll make that yellow. Okay. Depreciation equals previous year. And again, that's something that we will potentially change. And then what we're going to do is we're going to calculate EBIT, also known as operating income, by saying take the EBITDA and subtract the forecast for depreciation. I'm not going to make that yellow because we have a choice. We can either forecast operating income directly, or in this case, we forecast EBITDA, we forecast depreciation, and that creates our operating income. So we could have forecasted operating income and then backed into depreciation, but the preference I'm choosing is we're going to directly forecast EBITDA because it's a key driver of our valuation, forecast depreciation, and then we'll get our forecast created by the model for operating income. Okay. Next, we're going to need to know a tax rate. So we need to come up with a realistic tax rate for whatever we think is coming for the company. So for now, I'm just going to say equal the previous year. Now we might look at an average of the last 6 years, or we might look at something else later. But for now, we're just going to look at a placeholder equaling the previous year. Okay. So given our forecast for tax rate, we will then calculate a no plat. So you can actually see the formula over here, which is our operating income times 1 minus the tax rate. So I can either put in that formula or I can copy, I can paste this one over. So that is our forecast for no plat. And then finally, non-operating gains and losses. You can take whatever the previous year's value is a placeholder, again, make it yellow. So we've now forecasted the major drivers of the income statement. And then what I'm going to do is I said I wanted to go 6 years into the future. So I'm going to take 2017, I'm going to copy this, and I'm going to put it 6 years going through 2022. So 1, 2, 3, 4, 5, 6. The first 5 years will be the defined period. Year 6 is the T+1, N+1, beginning of continuing value period. Now, here's the next step. I then go to the income statement, and then I finish creating the income statement. So how do I do that? Well, we'll start out with EBITDA as our next forecasted line. And EBITDA will say, take the ratio for EBITDA as a percentage of sales, so H6 off the ratios tab, and then multiply that by, off the income tab, H3, which is the 2017 forecast for revenue. And I'm going to go ahead and take this column. I'm going to format this currency 1 decimal place to match everything else. Okay, so basically what we've done is we've taken EBITDA as a percentage of revenue coming off the ratios tab for 2017, and we've created the dollar forecast for EBITDA. I'm going to do the same thing for depreciation. So equals, go this way, 2017 revenue times ratios, the 2017 forecast for depreciation and amortization as a percentage of sales. So that will then get us an operating income, which you can see here, we're just going to calculate. So operating income is our EBITDA minus the DA, and that's the dollar forecast for operating income. Okay. Now, next, interest expense. One of the assumptions we're going to make in the model in an enterprise DCF, and by the way, I just realized these are actually going to become euros. This is dollars in our model, but Anheuser-Busch InBev as a Dutch company actually reports in euros. But regardless, we'll change that later. So interest expense, we're going to say equals the previous year. It's not going to matter to the valuation. We kind of need a placeholder number. And we're going to assume a company has a constant capital structure, so therefore we're not going to change its debt, which means we're going to leave the interest expense alone. Same thing with interest income, equals previous year. Won't matter to the valuation, we're just putting it as a placeholder. Same thing with foreign exchange gains and losses. We're going to assume are zero because it's too hard to forecast currency. Assume companies hedge effectively. So again, we're going to put that as zero. Shouldn't affect the valuation too much. Income loss from affiliates equals the previous year. And finally, non-operating gains and losses equals 2017 revenue times, and if you go back to the ratios, 2017 non-operating gains and losses as a percentage of revenue. Okay, so that would then get us our pre-tax income, and you can see what we're adding and subtracting over here. And just to save a little time, I can actually take cell G16, copy it, and move it over to cell H16. Okay, so we've quickly forecasted the pre-tax income for Anheuser-Busch InBev. Next, we got to pay taxes. So on this pre-tax income, we're going to multiply by ratios, 2017 tax rate. And that will then get us equals pre-tax income minus the taxes, the income before extraordinary items. Now, here's the thing about extraordinary items. By definition, they shouldn't recur. So therefore, we're not going to forecast them. Zero. Which should get us a net income before minority interest equals the income before extraordinary items minus the extraordinary loss. Okay. Next, net income before minority interest is calculated. So I need to subtract the minority interest. Again, whatever minority payments we're making, we're going to keep paying. Again, not changing the capital structure, which will get us equals net income before minority interest minus those minority interest payments, which will get us a net income. Cash dividends, because again, we're not changing the capital structure. Whatever dividends we pay, we're going to keep paying. So cash preferred dividends are the same. Total other adjustments, again, these are accounting adjustments that are non-cash typically that will affect the company from time to time. Again, very hard to forecast, so we're going to assume that they're zero because they're typically one-time changes, which will then get us our net income available to common shareholders. And again, you can see here, I can just copy and paste this over, or if you see over here, I could have just put in net income minus those two to get that one. And then finally, dividends paid. Again, we're going to leave the dividends alone. So whatever dividends are paying, they're going to keep paying. Now, it's just a quirk in Bloomberg, but preferred dividends and common dividends actually show up from the cash flow statement as negative numbers, where expenses actually seem to show up on the income statement as positive numbers. So I know it says we're going to subtract the dividends paid because Bloomberg is going to show us this as a negative number. What we're going to do, because I don't want to double count a negative and then add it by mistake, is that we're basically going to take the net income and we're going to add that negative dividend payment to get our change in retained earnings. Okay, so, and again, you'll notice here in the formula, we do the same thing where we're adding in the preferred dividends because they're going to come in as a negative number. So I know we're subtracting them, but we'll be adding a negative number, just formatting in Bloomberg. So again, we've quickly forecasted 2017. I will take this, copy this, and move this out 5 more years. And very quickly, we have created an income statement forecast through 2022 for Anheuser-Busch InBev. So based on these ratios not changing, and again, when we get to part 2 of the valuation model, we'll actually start changing these ratios. But basically, we've quickly forecasted out an income statement for 6 years based on those ratios. And if we go to our TII, since everything is mapped to the income statement, I can then take my TII, I can copy this, and I can paste this 6 years out, and I should have equals previous year plus 1, copied across. I now have forecasted TIIs, which balance for basically the next 6 years. Now, let's go back to our ratios, and let's now start forecasting the balance sheet. Now, here's where we're going to differ slightly from the book, in that, as a best practice, you should forecast a balance sheet item based on the corresponding income statement driver. However, to simplify things, what we're going to do is we're going to forecast all these balance sheet items as a percentage of revenue. So the book would say use inventories tied to cost of goods sold, but for simplicity, all of these ratios are a percentage of revenue. So in this case, equals the previous year. I will make this yellow, and I will copy this and basically paste this. So basically, we're just going to keep these as placeholders where everything stays the same percentage of revenue on a go-forward basis. The advantage of doing it as a percentage of revenue is, 1, simplicity. 2, it also drives productivity based on changes in revenue. So for example, as we forecast growth in revenue, since the balance sheet's tied to revenue, the balance sheet will grow as revenue grows, and the balance sheet will shrink as revenue shrinks. So it kind of implies a rate of productivity, which is based on the balance sheet ratio. So based on these ratios, we're now going to create the forecasted balance sheet. So let's start out for the ones we're directly forecasting. So the first one is accounts and notes receivable. So I go to my balance sheet tab. Again, just like the income statement, this is now my forecast. And I will do equals previous year plus 1. And then I will forecast the specific items. So the first one was accounts and notes receivables, a percentage of revenue. So here's what we're going to do. We're going to say for 2017, so this is cell H6, I'm going to go to the ratios tab, 2017, accounts and notes receivables, a percentage of revenue, times, from the income tab, my 2017 forecasted revenue. And again, I'm going to format this column, currency, 1 decimal place. In fact, let's make these other ones a little bit bigger when I copy and paste. So basically, I now, and save along the way, I now have a forecast of accounts and receivable as a percentage of revenue in 2017. Let's do the same thing for inventories. So equals, from the ratios tab, 2017 inventory as a percentage of revenue, times, from the income tab, 2017 forecast of revenue. Other current assets equals ratios, 2017 other current assets as a percentage of revenue times income 2017 revenue. Okay, the next one we're forecasting, just double check the list, long-term investments and receivables. So again, come down here, equals ratios, long-term investments as a percentage of revenue times income tab, 2017 revenue forecast. Net fixed assets equals ratios, 2017 net fixed assets as a percentage of revenue times income, 2017 revenue. Next one, other long-term assets equals ratios, other long-term assets as a percentage of revenue times income, 2017 revenue. Accounts payables, the next one we're forecasting, so equals ratios, accounts payable as a percentage of revenue times income, 2017 revenue. Next, other short-term liabilities equals ratios, other short-term liabilities as a percentage of revenue times income, 2017 revenue. So again, ratio is H13 times H3. I just want to make sure I'm doing this right. Hold on, I think I might have messed one up here. So let's go back to the balance sheet. Did that wrong. Equals ratios. Here it is. Nope. Equals ratios, accounts payable, there it is, which is H19, make sure you get the right ones, times income 2017 revenue forecast. There we go. And then finally, other long-term liabilities equals ratios, other long-term liabilities as a percentage of revenue times income 2017 revenue. Okay, so I have now forecasted these balance sheet ratios to create those balance sheet items as a percentage of revenue. Now, what I need to do is I need to finish off the balance sheet and, more importantly, get it to balance without creating a circular reference. So I'm going to show you how to do that. And we're going to start by finishing with the liabilities and equity side of the balance sheet first. So I'm going to go ahead and do equities. So basically, here's how we're going to do this. Preferred stock, because we're not changing the capital structure or the preferred dividends. Whatever you have, you keep, so equals the previous year. Same thing with minority interest in the balance sheet. Whatever minority interest you have, you're going to keep on your balance sheet. Whatever shares you have outstanding, you're going to keep. You're not going to issue or repurchase any new shares. Again, keeping capital structure constant. Retained earnings is the one thing that is going to change, and that's going to be driven by changes off the income statement. So our retained earnings are going to be whatever the previous year's retained earnings were, plus, we go to the income tab, for 2017, the change in retained earnings. So that would be how much retained earnings change if I basically had what I had true coming on the income statement, including the giant dividend that they were paying and not too much income last year. So retained earnings would shrink. So again, current year retained earnings plus change in retained earnings from the income statement equals next year's retained earnings. So the total equity would be the sum of those four items. Okay. Now, what we'll then do is we'll forecast the liabilities. So we'll start out here. Short-term debt. We're not changing capital structure. Whatever debt they have, they keep, equals the previous year, which means current liabilities would be the sum of those three things. Long-term debt. Whatever they had last year, we keep. Pension liability, same thing. We're not going to have an unfunded pension increase going forward, so we'll keep whatever unfunded pension we have, and then we'll sum those three, long-term borrowings, other long-term liabilities, and our pension, to basically get the long-term liabilities. Total liabilities are the current liabilities plus the long-term liabilities, and total liabilities and equity, total liabilities plus total equity, total liabilities and equity. All right, very important. We want to get our balance sheet to balance. So here's how we're going to do it. We're going to take our total assets and we're going to say equals total liabilities and equity. So we now have a balancing balance sheet. So from here, we need to finish up the asset side of the balance sheet. And then you're saying, well, gee, how's the balance sheet going to balance? Well, it involves having something called a plug, which means we basically solve for one item that makes the balance sheet balance. Our plug is going to be excess cash. So here are the other items. The next item is operating cash. Operating cash is going to come from the Assumptions tab. Operating cash is a percentage of revenue, so B3, times from the Income tab, 2017 revenue. That will be the operating cash in the business. Now, here's the thing about Excel. Since I'm going to use that one cell off the Assumptions tab, I need to make that an absolute reference. So $B, $3 when I copy it over. Okay, so finally, the other item that I'll need is goodwill. Again, since companies no longer amortize goodwill, they impair goodwill, we're going to leave goodwill alone. So that's the goodwill of the company. So now we can balance off our balance sheet by solving for excess cash. So equals total assets minus everything else, minus the operating cash, minus the accounts receivable, minus the inventory, minus the other current assets, minus the long-term investments, minus the net fixed assets, minus the goodwill, minus the other long-term assets. Whatever's left becomes excess cash. So now for current assets, we can sum all of the items above. For long-term assets, we can sum all of the items above. And we now have not only a balancing balance sheet, but we have a balancing balance sheet without circular references. So we can then take our balance sheet, copy this, and paste it out 5 more years. 2, 3, 4, 5 through column M, and we now have a balancing balance sheet through 2022. Now, again, we'll handle this as a assumption later, but obviously, given this level of income and this level of dividend, they're going to run out of cash in 2018. So for now, we're going to leave this as a placeholder, but we will address this when we do the valuation. But you'll see that the company is using excess cash to plug everything, and this will be essentially since we're not changing the capital structure, all the excess free cash flow that doesn't get paid out or needs to be borrowed is really just going to show up in this excess cash line. So now that we have the balancing balance sheet, we'll go to TFI, we'll take 2016, we'll copy this. We will take 2016, we will copy this, and we will go out through column N through 2022. Previous year plus 1. Copy, paste. We now have a balancing TFI. We'll now go to our CFI. We'll take 2016, we'll copy it and paste it through. TII goes through cell H. Oh, sorry, there's some hidden columns in here. Ignore that what I just did. Very important. Unhide these columns. And kill these hidden columns that I forgot to kill in your model. Right click, delete. And now we'll take it. So take column G, copy, and paste that out through column M. Those were hidden. So make sure you unhide and delete what was there that I forgot to put in the model. And so we'll have balancing CFIs. And then finally, EP, we take 2016, we copy it through 2022 equals previous year plus 1. Copy, paste, and finally EPEOY. Take column G, copy, 6 years, column M equals previous year plus 1. Copy, paste. So what we've done in a little less than an hour is we have created a forecast for 6 years worth of financial statements, which creates 6 years of, based on the 6 years of ratios, which creates 6 years of income statements and balance sheets, which creates 6 years of economic statements, which forecast 6 years of CFI and EP. And that's really what we need to do in the first step of the model. Now we're using placeholder data, basically just assuming 2016 repeats itself. And obviously we can see that they're not going to be able to afford to do that. But very quickly, we've built out a forecasting model, which as we can make changes in assumptions, will then change these cash flows and ultimately create the cash flows we use in the valuation. So if you've gotten to this point, and more in particular, if you get to a CFI of 12,547.1 in the out years, then basically you have completed part 1 or part A of our valuation. At the next class, we will pick up from here and then we will complete the model. This is where you need to get at the end of this video.